Good morning, ladies and gentlemen. Good morning from England.
Morning, everyone.
Good morning from Lawrence and myself. Good afternoon to others attending east of Great Britain. Welcome to this post-budget impact assessment webinar. We are just getting some screen technicalities sorting out. It was working a few minutes ago. It's working now. You've got the presentation in front of you. If we could enlarge the screen, we will do so. We're just going to go through a couple of introductions. Welcome back those that attended the prequel, which was in September, the pre-budget webinar. And then we had the Chancellor's unique budget on the 30th of October. And this is the post-budget impact webinar. Your same presenters, Lawrence Lancaster, Group Head of Tax of the Sovereign Group, and myself, Simon Denton, Managing Director of Sovereign UK Limited. Good to see many of you all back in the conference room. We've got a super turnout today, and we're going to tell you what we're going to cover in the next hour. Next slide, please, Miguel. That's the contents legend. We're going to put it into four parts, just to sort of let you know. This webinar is going to be recorded. The link to the recording, like the prequel to this webinar, the pre-budget webinar or pre-budget webinar we hosted in September, you'll get a recording link, and the first questions, will we get the recording material and the slides? Yes, you will. So you get a webinar link to the recording and the presentation. We got quite a bit to get through. 4 parts. We'll try and take we'll try and read through certain questions during each part to answer after each part, because there's quite a bit of detail going through part 1, 2, 3, and 4. And Lawrence and I are going to share the spoils on that. So do ask questions in the Q&A if you can, and or the chat, whatever's easiest, whatever you're tuned into, and we'll take the questions as quickly as we can through each part. So again, those that are arriving now, this webinar is being recorded. The presentation and the webinar presentation will be sent to you by email later this week, or very, very earliest next week. So moving over to my colleague, who's going to take you on to part 1, abolition of the remittance basis and its replacement with the regime for qualifying new residents. Next slide, Miguel, please.
Thank you very much, Simon, and welcome everyone, and thanks for everyone for joining us today. So we're going to start off in part 1 just with some generic summaries of what's happened in relation to the abolition of the remittance basis and the replacement regime that we've all been speculating about for all of this calendar year, really. We now have clarification. I should point out that the Finance Bill of 24-25 has now been published, and it's racing its way through Parliament. We're expecting it to become law in the Finance Act of 2025, probably in February of next year, so February 2025. All of what we're talking about today is draft legislation, so it could change. So I'll make that point at the outset. But we do note in certain parts of this, there were a couple of measures that were effective from budget day. So just note that almost 90% of what we're going to talk about will not become law until Finance Act 2025 enters into force. And then most of its measures will take effect on the 6th of April 2025. So to start off with, the Chancellor Rachel Reeves, in her budget that was delivered on the 30th of October, confirmed that the remittance basis of taxation is to be abolished. And it's rather than looking at the domicile or the non-domicile of an individual to access a special tax regime, it's now going to be open to persons who are called qualifying new residents, QNRs. So effectively, the new beneficial regime for the UK is only available to a QNR. Domicile goes out of the window, albeit there are important transitional measures that we're going to summarize. So what is a QNR? Well, a QNR is a person who has been non-UK resident for at least for 10 or more consecutive tax years as at 6th of April 2025. So the basic position is that you have to have been non-UK resident from before the 6th of April 2015 to ensure that you've done your 10 years. Obviously, you may have been non-resident before then, but the minimum is 10 consecutive tax years immediately before the 6th of April 2025. That's the basic rule. However, there is this transitional there are these transitional measures in place to allow persons who did their 10 consecutive tax years of non-residence, but then became UK resident on or after the 6th of April 2022. They can still access the QNR. They will still be QNRs, albeit for a shorter period. So we've given you an example here where an individual who was non-UK resident from the 6th of April 2012 to the 5th of April 2022. So they've done the 10 years and they've been UK resident for the next 3 years as of 6th of April 2025. They'll be able to access they will be a QNR and can access this new regime, but only for 1 year, which will be the 25-26 tax year. Okay. And what does it mean for a QNR? Well, a QNR who has qualifying foreign income. So note, it's not everyone saying it's all foreign income. It does have to be qualifying, and there's a couple of important types of income there that don't qualify. Important one, I think, is life insurance gains. They're not within, from my reading of it, the definition of qualifying foreign income, which may become important. So it needs to be qualifying income and or qualifying gains. They need to make a claim, and if they do that, and they need to make a claim and report it on their tax return, and assuming they do that, that income or gains will be exempt from UK taxation and can be brought into the UK without tax. And that status will be available for all QNRs. So note that the maximum period for which you can be eligible for QNR status is 4 tax years. So for individuals who have been on UK resident for 10 or more tax years, consecutive tax years on 6th of April 2025, they will be able to access the QNR for 4 tax years. But after that, it goes. So it's kind of like a cliff edge. You get this great regime for 4 years that is certainly more attractive than the remittance basis that, remember, was available for 15 tax years for non-doms. But then it just goes. So the planning that we're going to look at later is very much focused on utilizing this regime for the 4 years while it's available, but then mitigating your tax after that if you're going to remain UK resident. The final point is this repatriation facility. That's not to be confused with QNR. This is available for existing non-doms who are claiming the remittance basis, who have unremitted foreign income and gains. They would be well advised not to remit them in this tax year if they have unremitted income and gains and they're still UK resident and plan to remain UK resident. Wait until on or after the 6th of April 2025, then look to remit them, and they should qualify for this repatriation facility. The rate of tax, whether it's income or gains, is reduced to a flat rate of 12% if the remittance is made in the 25, 26 or 26 or 27 tax year. If you do it in the final tax year, which is 27, 28, the rate goes up to 15%. So you'd be well advised to do it in one of those first 2 tax years. The conditions are, as ever with UK tax, that there's 4 conditions that need to be met. We're not going into those today. You're going to need to get tax advice on that if you want to use it, but it is available and it is useful. So I think we can now flip over to
Yeah,
The
you're
next,
next on this one, Lawrence. And I think
yeah,
there's just one person, Denise. Sorry, having difficulty getting in, or you can't hear. It's Lawrence and myself you should be listening to, not Miguel. But if you might be able to switch on your machine and switch back on again, or go onto your iPhone. But let's continue. UK inheritance tax overhaul, Lawrence.
yeah, okay. So yeah, hopefully everyone's hearing us okay.
Yeah.
Good. So the other key fundamental change that has been or is being made to UK taxation is the overhaul of inheritance tax. Domicile, this concept that we've had in UK taxation, fundamental concept, is going now. It's quite clear that it is going to go, and it will be replaced in the inheritance tax space with this new concept of a long-term UK resident. So you've got these two new concepts. For the 4-year rule, it's a QNR. For inheritance tax, you've got this long-term resident, which replaces domicile. So the key is, are you a long-term resident or are you a non-long-term resident? That's replaced, are you domiciled or are you non-domiciled? So an individual will be an LTR, and we're referring to long-term residents in this talk as an LTR. I know there's a lot of new acronyms. We will from time to time go to the full term, but most we're going to use LTR. So an LTR is somebody who has been UK tax resident for 10 or more of the previous 20 tax years. So, for example, an individual who was UK resident from the 6th of April 2014 to the 5th of April 2025 will be an LTR from the 6th of April 2025. So I think an obvious question is, well, when does this period of 10 years, 20 years start running from? Well, it goes back to all the way back to the 6th of April 2005. That's when you need to start your counting, and you need to then determine whether you have been UK tax resident in 10 or more of those tax years come 6th of April 2025. If you've been UK resident in 10 or more of those tax years in that 20-year period, you'll be an LTR. Now, there are some nuances to this. There's some complicated tests, but that's the basic rule that you need to be aware of. So it's 10 or more tax years, looking back in the first year in 2025, all the way back to 2005. Have you been UK resident in 10 or more of those 20 tax years? If the answer to that question is yes, you will be an LTR. What's the consequence? Well, an LTR, just like a UK DOM, will be subject to UK inheritance tax on their worldwide assets. The standard exemptions will continue to apply, such as the spousal exemption and potentially exempt transfer planning. You'll note in our pre-budget webinar, we were concerned that pet planning could be abolished. Fortunately, that hasn't happened, but some of the things that we were concerned about have come home to roost, and we're going to go through that later. But for present purposes, just worth noting that if you are an LTR, and you may be somebody who's currently non-dom and has been UK resident for more than 10 or more tax years on 6th of April 2025, you'll then become an LTR subject to tax on your worldwide assets. The standard exemptions still do apply. Everyone is subject to UK inheritance tax on UK assets. That's always been the case. General rule is that a long-term UK resident, and this is concerned with how do you lose your LTR status? Well, you're lumbered with it for 10 tax years following the tax year on which you leave. So the general rule, and it is subject to certain exceptions, is that let's just say you leave the UK on the 6th of April 2026 as an LTR, and it will take you until the 6th of April 2036 under the general rule to renounce that status. So you'll have 10 years where your foreign assets, are subject to UK inheritance tax. So that's very harsh. It's harsh on non-doms who currently can lose the exposure at the start of the 4th tax year. And for that reason, there's an important transitional measure in place for non-doms, provided they meet the conditions. And one of the key conditions is that they become non-UK resident from the 6th of April 2025. That's going to be important for many non-doms to utilise that. So on that note, that kind of covers the key technical points. Simon is now going to take you through some of the other key private measures that affect private client tax planning, which is obviously the focus of this impact assessment. It's not to take you through all of the standard stuff that was in the budget, which you'll obviously all be aware of anyway, and is freely available on Google and everywhere else.
Thank you. Next slide, Miguel. Conversely to the last dark point that Lawrence has made on the inheritance tax, for those British people or British passport holders, British citizens, UK DOMs, former UK DOMs that have lived outside of the UK for more than 10 years, there's major opportunities for them to set up a trust, and we're going to cover that in one of the 4 case studies later. Yeah. Other measures, UK and overseas pension schemes, I'm going to quickly canter you through now. Business property relief and what's been in the news rather a lot this week. No thanks to Jeremy Clarkson, or thanks to Jeremy Clarkson if you're a farmer. Agricultural property relief. We've got 20 slides to get you through on from the 102 page proposed draft regulations. So we'll quickly move on and talk effectively on UK registered schemes, qualifying recognised overseas pension schemes, QROPs, and qualifying non-UK pension schemes. The latter has a little bit more of a shelf life than QROPs. So government proposing a radical measure, which would mean the pension fund remaining in these UK and overseas pensions will eventually be subject to UK inheritance tax. Yes, there's going to be a bit of consultation, but inheritance tax or inheritance tax exposure to apply to pensions from the tax year April 2027. I'm surprised the media hasn't attacked the government and the measures so much on this. Maybe it's the week for the farmers this week, and this will be published and shown on the wider news later on, especially we get closer to obviously 2027. Now, QROPs, qualifying recognised overseas pension schemes, are going to be now subject, immediately effective from the 30th of October 2024, to the overseas transfer charge. That means if you've got a UK pension, you move the fund into a qualifying recognised overseas pension scheme. Be very careful to get articulated advice on that, unless you're moving the fund into a qualifying recognised overseas pension scheme registered and resident in the country that you're moving to, for example, Malta, you are going to suffer this 25% tax charge. So please, pension technical advice before anything radical is made in regard to moving pension funds out to QROPs. There will be fewer QROPs movements, or fewer pension fund held in a UK pension to a QROPs, but in some situations it may still be viable, especially if you're going to move your pension fund into a pension scheme where you're going to be resident or are already resident. Business property relief to be restricted. I don't particularly like this. Effective from the 6th of April 26, so not the next tax year, but the one after that, the government will cap the 100% relief at £1 million being an allowance per individual. That's business property relief, BPR. So if BPR exceeds 1 million, then the excess will only attract 50% relief, which effectively means the inheritance tax exposure will be 20% on that person's demise or shareholder's demise. For clients, I didn't expect this, or we didn't expect it, others in the financial industry didn't either. For clients holding AIM-listed shares, which currently enjoy 100% relief from inheritance tax, I believe, after you've held them for 2 years, will be reduced to 50%, again, effective from April 26. So many would lot of perhaps more mature persons would have that were worried about surviving 7 years on gifting value to loved ones might have contributed their some of their investment into AIM. But as from 2026, 50% relief will only be enjoyed upon a person's demise. So AIM shares will be effectively taxed at 20% on demise, but effective from the fiscal year 2026. There's a bit of housekeeping and time to do before the implications of that change pertaining to these other measures. And again, what's happened in the news rather a lot lately, and rightly so, although the government says 3 out of 4 farms or farmers will not fall within these implications. I don't really believe that, but agricultural property relief to be restricted, again subject to the £1 million allowance. So if any farm attracting agricultural property relief is worth more than 1 million, the excess will only benefit from 50% of relief, and therefore a 20% inheritance tax will be imposed, which will be stressful and punitive for our farmers that essentially feed the nation. It's harsh when we take into account business property relief and agricultural relief, because the proposed 1 million allowance is shared between the two reliefs, that's agricultural and business property relief. So if the taxpayer holds an agricultural asset worth a million and a business property asset of another million, both assets will have £500,000 exposed. So technically, effectively, that's a 20% inheritance tax on demise, and maybe a little easier to move out, sell, or rearrange a business property asset, but much more challenging for a farm. They're the other measures. Please fire away with some of your questions. I'll have a look at those as Lawrence will take you through excluded offshore property trusts or excluded property trusts, starting with part 2, impact assessment. Lawrence, thank you.
Yeah, so we're now into the second part where we're going to be looking at how those measures that we've just gone through affect the structures that are already set up. So EPTs, excluded property trusts, can now be divided into 3 categories. The first category is EPTs that were established before the fully funded before the 30th of October 2024. Those EPTs, excluded property trusts, will remain grandfathered from inheritance tax, even if the settler of that EPT becomes a long-term resident, an LTR. So you could have a position where an individual potentially set up an EPT, say on the 1st of September 2024, and had been UK resident, say, for 14 tax years, or 13 tax years, actually, let's just say, that EPT, although that individual will become an LTR on the 6th of April 2025, a long-term resident, and their other assets outside the EPT will all be subject to inheritance tax, that EPT will remain grandfathered indefinitely from inheritance tax. So that is very good news for settlers who were non-domiciled, not deemed domiciled, and took advantage of EPT planning before this budget. Really, it is something that we suspected would have to happen. It wasn't in line with what Labour were saying in their policy documents, but it always just shows you shouldn't rely on policy statements from governments. It's the legislation that is always the key. And in the legislation, as we suspected, they backtracked, and there is grandfathering for EPTs for inheritance tax. So that's very good news for pre-existing EPTs. Less good news is that they'll be exposed to the relevant property regime. So in that example that I've just given, when the trust hits its 10-year anniversary, it will have the tax charge to pay then, which is never any more than 6%. And you will find that with EPTs that are historic, say you had an EPT that was set up in 2016, and its 10-year charge hits in 2026, when the settler is an LTR, you'll find that most of that charge will be relieved, because 9 out of the 10 years the trust was an EPT. So do bear that in mind, that while we're in transition, these first 10-year charges that EPTs will be subject to, there could well be some chunky relief available for historic EPTs. Just bear that in mind. But once the settler has been UK resident for more than 10 tax years, it's going to be subject to the relevant property charges. It doesn't mean there's a charge straight away. It's when the next 10-year anniversary hits, there'll be a charge and filing. But as I say, the charge could be mitigated. So generally good news so far. This is less good news, but is in line with what we thought. Income and gains that accrue to excluded property trusts directly will be taxed on settlers from the 6th of April 2025 if they are UK resident and are not a qualifying a qualifying new resident, so a QNR. So basically anyone who has been, any settler who has been UK resident for 4 or more tax years on the 6th of April 2025 and who has an EPT will be taxed on the income and gains that accrue to that EPT if they accrue to it directly. There is planning you could consider. The exclusion planning of the settler and spouse will ensure that income won't be attributed to such a settler. The other thing is that we are always recommending with these to have an underlying company. If you have your assets wrapped within an underlying company, then there's a good case with a supporting tax council opinion that the income and gains should not be attributed to the settler. So again, that's more good news for persons who are within EPTs with an underlying company. The second type of case is an EPT that's established between the 30th of October 24 and the 5th of April 25. This will still be determined by domicile, you're likely to find clients who may want to consider that are those who are going to be long-term residents and subject to IHT on their worldwide assets from 6th of April 2025 or shortly after that, but are currently non-dom and not deemed dom. They can utilize EPT planning and look at the exclusion of the settler and the spouse to provide them with inheritance tax and income tax planning, with potential to defer income tax on income and gains with care. And again, we're going to look at that later. The third type of EPT is one that's set up after the 6th of April 2025, and the massive change there is that the determination of the EPT status, it's still going to look at foreign assets have to go in, but it's going to be someone who's not a long-term resident who can set up an EPT. Domicile is going out of the window. And what is fundamental is that anybody who was UK domiciled before the 6th of April 2025 and who is not a long-term resident on the 6th of April 2025 can now set up an excluded property trust. Yeah. That's a surprise to us. That is more generous than what we thought. And I think that perhaps the government's thinking there is that because it's so harsh once you become an LTR to have to wait 10 years to get rid of the status, they've kind of taken, it seems, it on the chin to those persons who are currently non-UK dom and long-term non-residents who can now use EPT planning. But that's a pleasant surprise. And we're going to take you through a case study on that later, and also a case study on the second type of EPT Absolutely. Planning. So that's enough now on those, but it's just worth in your analysis on this to break it down into those 3 categories.
Lawrence, we've got to answer a few questions here because we don't really want to spill over on time, but they're excellent questions. Thank you all. One of the questions was we arrived a bit late, and of course you're going to get the presentation and a recording, so don't worry about arriving a few minutes late. George, how do you determine what date someone becomes a UK resident after an overseas posting? They'd be arriving into the UK, not leaving, and it's much easier to arrive and become tax residents and much more difficult to become non-UK tax resident. I suppose it's the date they arrived and the contract date. Lawrence, can you be brief on this?
Yeah, it's determined by the statutory residence test. So
yes, quite.
Even if you come in partway through a tax year, you have to apply the test to determine whether you've been UK resident, whether you're UK resident for the whole tax year. That's the first question you ask. And it's typically if you spend more than 90 days or 120 days, depending on your ties and which test you fall within, but general rule is that you'll be UK
and they will have a
resident
contract of UK employment, no doubt, Lawrence, as well.
Yeah. So if you fall within if you're coming to work full time in the UK, then you'll be UK resident for the whole tax year. But that is one of the heads that benefits from split year treatment. So you should, subject obviously to taking advice on this, only be UK tax resident from when your employment starts. Under split year treatment. It's broken up between the overseas part of the split year and the UK part of the split year. That's probably all we can say on it for now with time constraints.
Jonathan, an LTR, if I take up residency in another country after 2025, I'll still be liable for IHT on my worldwide assets. So if you're effectively an LTR when this legislation applies in April 25, he's going to have to be he's going to have to live overseas for until 2035 before it falls away.
Is he currently non-domiciled?
Doesn't say, Jonathan. So I think he's going to say if he's LTR as of 6th of April, that would mean he's probably is non-UK domiciled.
Well, I think this treatment is harsher for non-doms than UK doms, because if you think about it, if you're a UK dom and you leave, it can often take 10 years. Many people leave in 30 years and they're still UK domiciled. So really, if you're UK dom and you're leaving, it's 10 years now. You can kind of take that on the chin. Where it's very harsh is for non-doms who currently can, and even if they're deemed domiciled, they just need to be non-resident for 3 tax years. And at the start of the 4th tax year, they lose exposure to UK inheritance tax on worldwide assets. But there's this important transitional measure, which maybe we can just touch on, for persons in that position. So if you're currently non-domiciled under general law, you may be deemed domiciled UK resident. If you become non-resident from the 6th of April 2025, then the 3-year, 4-year rule will still apply. And you'll lose your LTR status from the start of the 4th tax year. But the sting in the tail is you've got to remain non-resident for the still for the 10 years in total. But the key is, rather than having 10 years where you've got exposure to IHT on worldwide assets, it's only for 3 years, and then your 7 years you're in the clear. So that is an important transitional measure. Okay,
and a comment from Howard. It seems to me that farmers might be able to set up a family investment company, and yes, they can. But what the problem is with the farmers, knowing a little bit about this, because I'm from Leicestershire, a county of farmers. Howard, I think you're originally from Yorkshire. Is that a lot of the farms are in debt. They have debt mortgages registered against them by the main and specialist banks, and to have the title shifted into a new company, an FIC, which we're going to come on to in a minute, you would have to get permission from the bank or have to pay up the mortgage, which is going to be highly difficult if you're a farmer. So it's not so automatic in terms of gifting the asset to the adult children or moving into the FIC if you cannot satisfy the bank and clear the mortgage, or have the mortgage paid up and a new mortgage taken out in the FIC. So that probably depends on the relationship with the bank. But that is often an obstacle. So a lot of these farms do have debt and bank debt registered against them. But we can.
And we're going to go through with the trust solution for BPR, which is equally applicable for agricultural property relief and farmers.
Exactly.
I think that's probably a better option than the FIC for a couple of reasons, but we can come on to that later. But I do agree that FICs should be on the table too.
Absolutely, they're soft for tax planning and acceptable to HMRC. Claire, thank you, Claire. Will the proposed IHT on QROPs and QNOPs apply to non-UK residents? That we have to raise that question. Great question, Claire. Thank you, Lawrence.
Yeah, so it won't apply to LTRs.
No.
Because it won't apply if you're not a non-LTR. Let's get this right. So if you've been non-UK resident for more than 10 or more tax years, when this measure comes in, and the measure won't come in, they're saying, until 6th of April 2027.
Yes.
So as long as you can ensure that you're either a non-LTR or on your way to not being an LTR by then, you should be fine. I say that with a qualification. If you hold the asset in a QNUPS or a QROPS, you should be fine because the asset is a non-UK situs asset, so that's excluded property and will fall outside the scope of these very, very harsh measures once you're in the freedom of being a non-LTR. But if you're a non-LTR and you hold, say, a SIP, I still think there's a problem because that's a UK asset, and obviously the exemption for non-LTRs is for overseas assets. So that's a good reason to move your pension out to an overseas
because Jim
pension.
says, Lawrence, does Jim from Dubai, hello, Jim,
Hi, Jim.
does this apply to SIPs? And it's a UK asset, Lawrence.
Yeah, so the proposal is that they're going to remove the exemption from inheritance tax for registered pension schemes, which are SIPs, and QNUPs. Now, QROPs are also QNUPs. So it basically means that there's three affected pension wrappers: registered pension schemes, QROPs, and QNUPs. But to answer the question, if you are not an LTR, so you've been non-UK resident for more than 10 tax years, you should be fine if you've got your fund in a QROPS or QNUPs, because that is excluded property. So the advice for clients in that position is to be looking at trust planning, especially if you've got UK resident beneficiaries, to ensure that there won't be any inheritance tax. Well, that's fine, but more importantly, in that case, to not have income tax that you would get if you paid to a UK resident. So that's the type of planning that you need to be considering. But the key to that is to not be an LTR, and that is going to require 10 or more tax years of non-residence.
Okay, and a couple more. Let's be brief on the answer we can. Martin, thank you. Do you know if transfers from an LTR, let's say effective in 6th of April 25, Lawrence, to a non-LTR spouse, yes, there's a few of those around, isn't there, will need to be survived by 7 years?
No. So if you're a non-LTR, then it's like being non-dom. So if you're making a gift of overseas assets, that's now what we call excluded property in inheritance tax. It's excluded. So you can make a gift of that without the need to survive for 7 years. And if you're making
Lawrence,
a gift,
this is Martin, for example. No,
do
you know if a long-term resident gifts to a non-long-term resident spouse?
Sorry, the other way around. So in that instance, you would need to survive for 7 years.
Yes.
So it's going to be the same as at the moment where you're going from a UK dom to a non-dom.
Yes.
The spousal exemption is limited to 325. It's going to be exactly the same. But just think about it, that domicile has been replaced by long-term resident. So either a non-long-term resident or a long-term resident, that's replacing domicile or non-domicile. Exactly the same reliefs and everything apply.
Okay, and there's a couple of questions. We've got to move on now. There's a couple of questions. If I've been non-resident for 10 years, that may be persons that are coming to me that are British, born in Britain, British passport, British domicile of origin under the current landscape. But if they've been non-resident for 10 or more years, many have been for many more years than that. John from Portugal, then once this legislation applies as from the 6th of April 25, and the domicile landscapes move to a residency-based landscape, non-UK assets should not be exposed to UK inheritance tax. Only UK assets will be exposed to inheritance tax come the demise of the last surviving spouse, for example. Lawrence, do you agree?
Yeah, that's right. And I think the point is that there's no for persons who are currently UK domiciled but will be non-long-term resident from the 6th of April 2025, they qualify immediately.
Absolutely.
So that's the surprise. Yeah.
So Miguel, if you're still there, please, we better move on. And thank you for the great questions. Any questions we can't answer because we're out of time, we will be getting back to you on the email. I'll answer the easy ones. Lawrence can answer the difficult ones. Now, qualifying non-UK pensions. There's been a couple of questions on this. Hopefully this will assist in responding positively to these questions. Not immediately impacted by the budget, but by the budget. Consultation period up to when the government is proposing to remove inheritance tax benefits, which is 6th of April 27. I even set up a QNUPS for a client after the tax advice and the financial planners came to the table, because the QNUPs was going to invest in residential buy-to-let property, which traditional pension schemes cannot. So still merit and use for QNUPs pre and post 2027, case by case though. So QNUPs are not QROPs in terms of they are qualified non-UK pension schemes, normally not receiving tax relief funds, and they still benefit, and that may continue hopefully, from capital gains tax exemption, especially if the QNUPs trustee invests directly into UK and overseas real estate, hopefully making sure that real estate is rented, generating a useful level of income that will be used in the future for the member once he or she retires and goes into drawdown. Reasonable contributions to QNUP should not be subject to an IHT entry charge, especially if the member is of a good age, and not with respect to older persons ancient. Income and gains potentially benefit from gross roll-up, like a traditional pension scheme. QNUPs do not have or not exposed the 10-yearly charge and exit charge. That's why these advisors that I worked with recently were still fairly bullish about the use of a QNUPs. Tax-free lump sum up to a maximum of £268,275, potentially available. Other benefits, tax as income if the member is UK resident, but some of the members, for reasons that we will talk about in part 4, may decide to enjoy a colourful retirement overseas, enjoy non-residence, and eventually become non-resident for 10 or more years. And there's plenty of countries to choose from that we will analyse and showcase with you. And QNUPs fund are exempt from IHT on death, but that may change in 2027. So QNUPs still on the shelf, case by case, can invest in UK residential and overseas property, and a diversified range of other assets which may not be totally applicable to a UK pension scheme. Thank you. And we go on to next slide, please.
Yeah, so
Lawrence,
this is
thanks,
Simon.
please.
So this is the planning that could be needed for pre-existing structures. We've kind of indirectly covered this already, but if you've got a pre-existing 30th of October EPT, the general advice there is to just leave it in place. Don't need to do anything as long as you've got the assets wrapped in that company that I mentioned earlier, overseas company. If you've got a bare EPT with assets held directly, you're going to probably want to consider, because although it's good for inheritance tax, you've got potentially income and gains attributed to settler from 6th of April 2025 if the settler's UK resident and is not a QNR. So what you're going to want to consider there is exclusion of the settler possibly, and potentially using other types of arrangements. So what you could consider there is life insurance potentially. And if the settler is excluded and their spouse, potentially PCCs are useful for ensuring that gains aren't attributed to the settler. All of this is going to be worked through, but there are options open for those persons who did place their assets into EPT in time. So definitely options open. In terms of family investment companies, they're unscathed. The only thing is that runs through all of these structures is that if you will be a QNR from the 6th of April 2025, consider probably you don't want to be withdrawing income from anything that's overseas. Obviously, the FIC could be UK, so that's not going to qualify for QNR because it's UK income. But assuming you've got an overseas FIC, EPTs will be overseas, as will QNUPs. Consider deferring taking income until the 6th of April 2025, because you'll then be exempt if you're a QNR and it can be brought into the UK. We've already mentioned QNUPs. In terms of planning, just leave it in place for now. Consider planning options. And the main planning option is going to be becoming non-UK resident. Another potential planning option for QNUPs, which is not available for QROPs or registered pension schemes, is to transfer to a different type of wrapper if they remove this exemption, which is going to be harsh. You may find you're in a bizarre position that you're better off transferring to a different type of pension scheme. It will be more tax efficient from IHT, that's something we're going to look at. At the moment, just hold fire, be aware, and be vigilant, and keep a watch out on developments as this goes through, as it unfolds. So we can go on to the next slide now.
Case study now, Lawrence. So there's
Case
four
study,
case
and
studies,
it's
ladies
over
and
to you.
gentlemen.
Yeah.
We'll share these. There is a Richard I can think of actually in this, in a genuine situation. UK domiciled under the current landscape, has lived in Australia, which is a top 3 destination to move to, ironically, for British taxpayers and British nationals, and lived in the UK since Australia, sorry, since 2010. He's married. I think he's married to Julia, and children will return to the UK in the new era next tax year, where there's going to be a residency-based landscape, and they'll be tax resident in the 25-26 next fiscal year, and will remain so, especially for the younger children who've got educational formalities to address and look forward to. Now, Richard's done well. He's got a £4 million investment portfolio in real money, and he's young enough to undertake short-term assignments of consultancy, not necessarily with a UK client base, and he will perform these duties when he's resident for 2 to 3 years, or maybe up to 4 years. Bearing in mind he's when April comes, he will be not resident of the UK for 10 years. He's might have been non-domiciled at the time, or deemed domiciled, but we can't look at that anymore. So Richard has been recommended to set up a Guernsey company in this case. The investment portfolio in specie transferred to Guernsey company, and Richard's going to be an advisor of that company, a consultancy contract awarded to him, so he can perform the duties as a consultant for those short-term assignments. And Richard wants to keep that offshore company status, Guernsey registered, Guernsey managed until December 28. Perhaps that's the 4-year term there. The Guernsey company will enjoy the income and gains and won't be taxed in the UK, despite being UK resident. And this is because he's got that qualifying non-resident regime, or Q&R exemption. Even dividends paid to Richard during the time that he is UK resident for the first part will be exempt, and can, unlike the existing regime the last 200 years, even if remitted to the UK, will not be subject to UK taxation. So we go on to these sort of next slide, Miguel, and the diagram. So we've got Guernsey company set up, Richard in this case the unique shareholder, contribution of assets into the Guernsey company, that's the £4 million investment portfolio, ladies and gentlemen. Guernsey-based directors, and Sovereign is licensed and regulated to undertake management control. We have been for the last 37 years, so we know what we're doing in terms of providing directorship services, fiduciary management control, economic substance, and making sure the Guernsey company is managed offshore in Guernsey and not from the UK. Tax treatment, and that's the tax treatment for the next 4 years, but effective from the next tax year of April 6. Guernsey company, yes, we know that Guernsey companies are taxed at 0 in Guernsey, but Guernsey company not subject to UK tax either. So income and gains accumulating in the Guernsey company not taxed. Richard not taxed on company income and gains, so no attribution. And when dividends are paid to Richard, as he's realizing that cost of living is quite a bit higher when he was last in England, dividends paid to Richard not and remitted to the UK or directly into the UK, not taxed in that 4-year period. Next slide, Miguel, please.
Just to make a quick point on that, because in other jurisdictions it's not always this case, but it is quite clear in the draft legislation that the transfer of assets abroad rules and the sister legislation for capital gains are switched off if the individual is a Q&R, provided the income and gains are non-UK source. So that's where you're going to be needing a company in place if you've got income that potentially could be UK source if the individual is engaging in it themselves. For example, consultancy income, you really need a company there to ensure that it's non-UK source income. But this is a fully legitimate structure now. Seems strange given all of the anti-avoidance legislation in the UK that's been enacted over the years, but this can be utilised even by UK Dom, who is a QNR from the 6th of April 2025 for 4 years maximum. That's its shelf life.
Okay. And yeah, Lawrence, you've still got quite a bit to do, and I've noticed the time. We've had 10 minutes of questions, and looks like we got 10 minutes more. So please stay on. And yes, there's a question on this. Sam, thank you. I think I know who you are. And the costs for managing a Guernsey company, registered office company secretary, domiciliary economic substance directors, no surprises, depending on the trading activities, are going to be less than £10,000 a year. So between £5,000 and £10,000, no nonsense sort of quote there. And that's competitive for Guernsey. So the last, yes, that is it. Number 11, Richard will look to restructure his Guernsey company into a family investment company, ladies and gentlemen, from when that ONR status is finished, April 2029. It may mean that the Guernsey company has to be registered with HMRC. The Guernsey company pre that will be, or a little bit pre that, will have its share classes divided: A shares carrying voting rights, B shares carrying rights to income and capital. Richard will be the voting shareholder, head of family, conducting the orchestra. And he will settle the B shares and some of the A shares into a UK trust. Now, at this stage, the shares will be located in Guernsey when settled, and the transfer into trust should not attract any IHT entry charge, getting the right timing there. Richard and his wife are then appointed as directors because he's past the four-year magic period, the FIG period. So it's controlled and managed in and from the UK. We make no, there's no, that's totally transparent, totally evident. Oh my God, it's become a UK company. No, for tax purposes, no problem whatsoever. Company is going to be subject to corporation tax in the UK on its net profits after deductions of expenses and allowances. But Richard's still not taxed on the company's undistributed profits. And the likely choice of a trust, ladies and gents, is an interest in possession trust for the children who will at least be 18 from, yes, they will be 18 from April 29, not next year, April 29. Trust subject to the 10-yearly charge, but no UK IHT, and the 10-yearly charge probably mitigated. So we're moving a offshore company just before pre 4-year expiry, moving the company into the UK for registration with HMRC to become a UK family investment company without having to close things down, start again, extra cost. And this is acceptable and compliant tax planning. Case study 2, Lawrence, Randolph.
Yeah, so Randolph has been UK resident continuously since the 6th of April 2011. So the 2024-2025 tax year is Randolph's 14th tax year of UK residence. He's not currently deemed domiciled, therefore, for tax purposes. He's non-dom under general law as well. He's aware that his overseas assets will become subject to IHT from the 6th of April 2025, when he will become a long-term resident, and he wants to put in place a trust immediately to ensure that the settled assets are removed from his chargeable estate for IHT purposes. The beneficiaries of the trust, which he settles in January 2025, are his 3 children, 2 of whom are UK resident. So if we just move on to the diagram. Next slide, please. Yep. So there you see the illustration. We've got Randolph there, overseas assets. That's still an EPT. This falls within the second category that I mentioned earlier, because Randolph is currently non-dom. The trust is settled before the 6th of April 2025. So it's still domicile that determines EPT status for now. A few more months. Overseas assets are going in. Beneficiaries. Randolph is excluded. Randolph's wife is excluded. His children are included. We have an overseas trust here. Sovereign Isle of Man will be using for this, and its overseas assets, just a standard investment account, is held directly in the trust. There won't be any lifetime inheritance tax charge on Randolph because he's doing the transfer before the 6th of April 2025. On or after that date, there would be. Income tax is deferred because the settler and the spouse are both excluded. More care is needed with capital gains tax attribution. Gains will be attributed to Randolph as a UK resident, even if both himself and his wife are excluded. There are options, though. You could consider the use of either a life insurance policy or a protected cell company, both of which should be effective. But great care is needed with either of those. For this, yes, as we mentioned earlier, you do have your 10-year charge which will be in January 2035. Randolph is quite happy to accept that. He's sort of beyond 60. It falls within that category. He really wants to put the assets into trust while he can to ensure that they're outside of his estate for IHT purposes. There will be individuals in Randolph's position who will still want to take advantage of EPTs while they can before they become an LTR on 6th of April 2025 or in a tax year shortly after that. So we can now move on to case study 3.
Case study 3. So
Laura.
This is the good Laura, 60, UK resident domicile, 3 children, adult children, and she previously enjoyed the potential full exemption from IHT come her untimely demise because she invested in AIM shares, and was a bit shocked to find that they're going to be exposed now in view of the changes announced by the Chancellor. So for IHT, that's for IHT person, but so planning or holding those shares will be less effective from April 26. Don't forget, it's not next tax year, the year after that. And she wants to lock in the IHT relief now, which is not so complicated. She has other assets and does not need the income and capital from the AIM portfolio. Miguel, next one. And this is what it looks like. The UK domiciled, UK resident, and yes, we deal with clients regardless of residence and domicile, ladies and gentlemen. Laura, British lady, contributes in specie the AIM listed portfolio with the help of the financial experts to the UK trust. And yes, we do have one of these, a Chester-based trust company that we own, Sovereign Trust of the UK trustees. The assets after the initial contribution of £100 is the AIM listed portfolio of 2 million. And it is Laura's children, the adult children, that are the key and fundamental beneficiaries. Important to comply with the changes in regulations governing trusts, that Laura and her good partner are excluded, permanently excluded. So the entry, there's no entry charge going in from the contribution, despite being above the nil rate band, because at the moment, the AIM listed stock, the portfolio, enjoys full exemption from IHT, which is true. And she's got to 2026, but best she does this now. Shares will have net gains. Capital gains, the shares will have net gains, but capital gains tax holdover relief will apply. Gains deferred, but you've got to make that claim, and you've got to have your accountant doing that or making these claims effective from when effective from the new regime. No inheritance tax on Laura's death, and which wouldn't be the case if she held the AIM shares in her own name, because from 2026 they're going to be exposed to half the rate of the regular inheritance tax, being 20%. And you've got the 1 million allowance challenges as well. UK trust will be subject to UK income tax and gains on future gains, but holdover relief applies. And you've got the 10 yearly charges, but it's still a very useful measure for Laura to undertake. The savings, she'll have the cash flow, and she'll have the legacy in favour of her adult children, saving at least 20%. Last case study now, Lawrence.
And that solution can be used also for APR as well.
Yeah.
Same reliefs are available. So this final case study on this topic, this part, Carol and Mike have been non-UK resident continuously since 2012, but are still UK domiciled. They previously resided in Hong Kong, but now reside in Malaysia. They have two children who are UK resident at boarding school, under 18, and have been UK resident, both of them now for more than 5 years. Carol and Mike plan to retire in Thailand and visit their children regularly. And they've actually been advised that once the children both reach the age of 18, they can return to the UK for 120 days each tax year, and stay in their property, which they've retained in the UK, and not be UK tax resident. That's what they plan on doing. Very common, I think, this type of scenario. The parents want to put in place some succession planning. They don't want to give away all of the wealth that they've generated while they've been in Asia to their children directly. Two main reasons for that is that, firstly, the children are likely to become LTRs, and the assets will be locked into the UK inheritance tax net potentially indefinitely. Secondly, the children will be taxed on income and gains as they arise. So for those two reasons, as well as for standard asset protection and succession planning reasons, they want to use a trust, and this is what they do. So if we look at the next slide, that shows you the illustration. Remember that they're still UK domiciled. If they did this now, there would be a 20% entry charge on basically on 8 million. But they don't. They wait until after the 6th of April. And note that we've underlined there settled post 5th of April 2025. So the investment portfolio goes in. Note with this, Mike and Carol can be the beneficiaries of this trust along with their children. There's no problem here with exclusion or anything like that. It's just a good old-fashioned EPT, but it's just that non-domicile has been replaced by not being a long-term resident. And that opens up the door for all of these individuals like Mike and Carol to use EPT planning. Obviously, if the whole family has no UK connections, they won't need an EPT, but it's going to be this kind of common scenario where children and grandchildren are UK resident, but the parents or possibly grandparents are non-resident and aren't LTRs, and can now use this. So there's no inheritance tax charge on the way in. Income and gains can accrue overseas in overseas trust without any charge to UK taxation. No 10-year charge, no inheritance tax, and UK residents are just taxed on a benefit received basis with planning options open to them, such as loan planning. So I think that it's kind of a positive note to end on with these case studies, that this is a new solution which the Labour government have provided everyone with who is in this position, of course.
Okay, we've there's still over 350 of you in the room, so thank you for staying on. Next slide, Miguel. It goes into part 4, but this presentation is going to be sent to you all with a recording link. But this quality reference document, ladies and gentlemen, becoming non-resident, a lot of you since the up to the election, post-election, there's been a lot of crossroad navigating, clients of ours still wishing to leave the UK, retirement purposes, entrepreneurial purposes, cost of living purposes, a life choice. And this is actually happening in 2023. There was 500 British taxpayers that did leave the UK to reside overseas for reasons of their own choice, and that trend is continuing and not going to go away. Popular nations that British taxpayers, that's British born persons and British taxpayers that may not be domiciled or perhaps are deemed domiciled, where they're tending to move to. Some will go back to their origins, some won't. And I pick on the European Union, the nice little club that we left regrettably a couple of years ago. And it's ironic that 10 years ago or more, the EU sort of outlawed tax competition, and now over half of the jurisdictions are all at it, promoting attractive incentives, low and no tax residency programs. And I start in the EU, ladies and gentlemen. The best way to describe this grid, you've got the EU in the first 2 pages. You've got the tax regime. And it's funny, isn't it? that the UK have abolished their UK domicile regime for the first time in 200 years. And all of a sudden you get Greece, Italy, creating a version of our domicile because they realize that it's a good way to get foreign income back into the country, expatriates returning, and foreign people wanting to move to their shores with very attractive tax concessions. So we've got Cyprus, Greece, Italy, Malta having a classic, almost classic non-dom regime. And the Republic of Ireland isn't changing. There's no time limit on the non-dom regime in the Republic of Ireland. That's in the next page. So you've got the tax status and the tax regime. The financial status, well, these are onshore EUs. Residency period qualifications. Moving over to the right side, you've got tax implications. Pensioners regime of 7% in Greece and Italy. You've got the lump sum tax regime, which sort of replaced the remittance basis in Italy and Greece. It's £100,000, €100,000 remittance basis tax regime, lump sum tax in Greece. It's just gone up to 200,000 in Italy. You've got the non-dom lower burden of cost and tax in Malta and Cyprus. And if we go to the next slide, Miguel, we'll see Portugal slightly less popular because they've still got their golden visa and D7 regimes, but they've unfortunately lost their non-habitual residency regime, which was the best residency program, I think, in the world, certainly in the EU. Republic of Ireland not to be forgotten about, not to be treated any less important than what I've shown. And you've got again a lot of golden visa opportunities for Schengen travel, but Spain has the nomadic residency visa and the Beckham law that your first 600,000 is taxed at 24%. So nation, regime, financial status. This is the EU chart, residency period, tax implications and requirements. And if we go over to the next slide, and thank you all for staying on, we've got back into alphabetical order, the no tax regime of Bahamas, especially those that like a little bit of entry into the US. The US of A, on the basis that you stay non-resident of the US, but up to 90 days is normally allowed before the IRS get a little bit interested. Bahrain, Dubai have, like Monaco, have no personal taxation inflicted on residents. And usually the younger fraternity for people heading to Bahrain, the Emirates, are going for business reasons. And a byproduct of setting up your own business in Bahrain and the Emirates, becoming the 100% shareholder, not having to share any ownership with a local indigenous member of society, being in control, being a member of that company, exclusive shareholder, complete foreign ownership, allows you to enjoy immediate immigration and residency, and you can stay there pretty much forever as long as you renew the status of your company and the status of your visa. It's 9% corporation tax in the Emirates, introduced a few years ago. It's 0% in Bahrain, but anything if profits exceed 750 million euros, it's 15%. So that's not probably going to qualify for going to spoil for too many people. So 9% corporation tax, 5% VAT in the Emirates, big deal compared to what we have to put up with here and elsewhere in Europe. So Bahrain, the Emirates, Middle East, for market entry, for business and lifestyle, pretty useful. Coming back to Gibraltar, you've got low tax, as you do have in Hong Kong and Singapore, mid-shore low tax. And under the qualifying residency rules, one can become a resident of Gibraltar and you pay a fixed minimum tax of £37,000, and generally that's all that is needed. So extra tax, but at least it's capped at that 37,000. Hong Kong and Singapore source-based taxation. A lot of people go for work, employment, expanding a business, setting up a business, but you've got the capital investment entrance scheme. The details are there, so fine print I can hardly read it. And the next slide, and maybe the last slide on this, Miguel. Mauritius, Europeans that have a attraction to that part of the world, South Africans and people with exposure to Africa. Mauritius, wonderful place to live, low tax, 15% tax only on income accrued and derived in Mauritius. It's a mid-shore jurisdiction and wonderful class of residency programs, investor categories being professional, self-employed, retirement, but even a property, which you get a handsome property for $375,000, gets you residency in Mauritius. Monaco, if you can afford the cost of living, there's still zero tax. Principality of Andorra back in the top 17. Seems like the Champions League, doesn't it? 10% income tax. It was introduced a number of years ago, but it's a low tax regime, passive residency for perhaps more the retiree type, and active residency by setting up a company. And the corporation tax in Andorra is 10%. I've covered Singapore and Switzerland, especially for capital gains tax planning, capital gains tax exit planning. There is no capital gains tax, and you can negotiate with the canton in Switzerland a regular low amount of tax based on expenditure multiples, not your worldwide wealth and your worldwide income. Minimum tax is still going to be about 150,000 Swiss francs, but if you've got a capital gains tax exit to conjure and materialize, you could become non-UK resident in this fiscal year. As an example, become resident under the lump sum regime in Switzerland during this fiscal year, sell your UK or international business in the next fiscal year, no capital gains tax in Switzerland, stay out of the UK 5 or more 6 years, and you'd be surprised how many British people, British taxpayers in Switzerland. There's that agreement between Switzerland and the UK, who are actually unlikely partners, and we actually get on very well with the Swiss, and there's a lot of business going between those two countries. That's the residence grid. You're going to get the presentation, you're going to get the recording, and yes, there's still way over 300. So if we can go back to some questions, and if Lawrence, if we can be snappy on the questions. Do you think, Jonathan? Wow, sounds like it's one of my questions. Do you think the Conservatives, if they get back into government, Jonathan, will change the IHT on pensions, BPR, and agricultural relief back in, if and when they get back? I think they tend to leave legislation alone that's been changed, and don't necessarily do a U-turn because they can blame the others. So that can't be relied upon. But Lawrence, do you have a quick 10-second answer on that one?
I'd agree, yeah, with what you've said.
Yeah, they don't normally change. And
the legislation is going to come in before the next general election. So if the Conservatives return, it will be in place, and it's unlikely that they'll be in a position to they'll need the revenue from it. So
yeah. Andreas, thank you, Andreas. I'll send that answer to you more thoroughly on email. UK Trust and Guernsey Company. UK Trust technically about £3,000 a year. Brian, for clarification on non-dom status, if someone became resident in Guernsey or another country that's outside of the UK before April 6, 2021, Lawrence, so they were residents of the UK for the tax year 2020-21, they would be non-dom of the UK for 6 of April 2025. But at 6 of April 2005, you got the abolition of the remittance basis and the landscape of domicile changed residence, and therefore avoids long-term residency rules. But don't you have to look back, despite being non-dom, being away, you've got to look back in the preceding 20 years, even at the 6 of April stage, Lawrence?
Well, I think that case would fall within the transitional rule, wouldn't it? So,
yes.
As long as the individual has to be non-UK domiciled on the 30th of October, I think is the best, 2024, they can be deemed domiciled. They don't have to be. So they could have been resident for 15 or more tax years on that date, but they must retain their non-domicile, under general law. There's no requirement, I don't think, for them to be UK resident. The key is that they're non-UK resident from the 6th of April 2025 for that tax year 25-26. So if they meet those conditions, then the old rule effectively applies. So I think that would apply to the case that has just been described. So if we work it through, if the individual was non-UK resident from the 6th of April 2021, let's just say, come 6th of April 2025, they meet the general rule because they've been UK resident for 10 or more of the previous 20 tax years, but they fall within this exception, which is that they were non-dom on the 30th of October, and they're going to be non-UK resident for the 25-26 tax year, so they should fall within that. And that should then mean that their worldwide assets remain outside of inheritance tax come 6th of April 25, because they'll have done more than 3 consecutive tax years outside the UK on that date. So they should be okay. Yeah.
Tony, and next slide, please, Lance. Just those good people that are still in the are still in but need to go. We've still got 300 in the room. You've got our contact details there. So if you something extra you want to send to us, you've got email to Lawrence and myself. Send it to us both. Tony, I have a best don't say his surname. Tony, I have a QROPS in Gibraltar since January 16. I've been out of the UK since February 24. Yes, this tax year, I suppose. All of this tax year. The presentation suggests I think I will be a long-term resident in April 25. I have also a residential property UK, permanently rented. Does this mean my QROPS and other UK assets will be excluded assets? Maybe we want to answer that one separately. It's a bit confusing.
So it depends on whether you're non-dom at the moment. If you're UK dom at the moment, then you won't fall within the transitional measure that we've been discussing. So even though you've been UK resident for 24-25 tax year and presumably will be non-resident going forward, if you're currently non-dom, you won't qualify for the exception, and then you'll need to essentially do the 10 consecutive tax years of non-residence to ensure that you're not a long-term UK resident. So that's going to take you into, say, 2034 kind of time if you've already done 1 year already. Once you're there, then your worldwide assets are fine as far as inheritance tax is concerned, and that includes your QROPS that you set up in 2016, I think you said. I think that's quite useful that it's a 2016 QROPS fund, because you'll be outside of the member payment charges still.
Correct.
Only after being non-resident for 5 or more complete tax years. So you may find that you can do some planning there, subject to getting specialist advice, after you've been on from the start of the 6th tax year, if you wanted to potentially move you to something else, that if indeed this attack on pensions comes in on the 6th of April 2027. That's something, if any people who are still in and have QROPS need to be kind of mindful of. Once you're outside of those member payment charges, that opens up the door for some planning. If you find that your fund is suddenly within the IHT net come the 6th of April 2027, of course you could just leave it in place, and once you've hit the 10-year mark, you're okay as well, because it's no longer within the IHT net because it's excluded property. Okay.
Message from Andy. He'll fly into Singapore to have a chat with you. Thank you, Andy. He enjoys Singapore. You probably know it anyway. Susan, we are UK couple living in Portugal. So UK domiciled living in Portugal. We will both be qualifying non-residents, Q&R exempt, and plan to gift us cash sum from assets outside of the UK to our son living in the UK. Will this be exempt from the 7-year IHT rule from the 6th of April 25? Quick answer, please.
So they're saying on the 6th of April 2025 they will have been non-UK resident for 10 or more consecutive tax years?
They're
not?
just saying they will be Q&R exempt, and plan to give quite a bit to their son.
Yeah, I think it's important not to mix the two concepts. So there's two
Yeah.
distinct concepts. One is long-term non-resident, and one is a qualifying new resident.
That's right.
So for inheritance tax planning, we're looking at you being not a long-term, not a long-term UK resident.
Right.
So if on the 6th of April 2025 you have been non-UK resident for 10 or more tax years,
10 or more,
so
which I think Susan has.
yeah, then you will be free to gift foreign assets to individuals, even if they're UK resident,
Yeah.
and there'll be no need to survive for 7 years because it will
Yeah.
be a gift of excluded property. It's
Like a
outside
foreign
of
person giving foreign assets to a UK resident.
Yeah. What I would
Yeah.
say there, though, is that if you're making cash gifts, it's normally better to execute a deed of gift first
Deed
to
of
make
gift.
sure, to make it clear that you're giving the property away when the assets are held, the cash is held in an overseas bank account.
Yeah.
Because the danger is if you make a transfer to a UK bank account, HMRC could argue that the gift was affected when it credits their bank account, and then you could be into the 7-year rule. I don't know if there's any authority on that, but you could bet that HMRC are going to take that position. So you can avoid that by drawing up a deed of gift correctly drawn up, which you can obviously help with. Yeah.
Thank you, Lawrence. Roger, hello, Roger. Still on. I'm a UK citizen, domiciled currently, but I've lived and worked in South Africa for 15 years. And if he's living and working in South Africa, I don't believe he's dual resident at all. He's only resident of South Africa. And in April,
you'd assume so. Yeah.
Yes, let's assume that. And I think Roger,
Yeah.
sorry, you should have perhaps said that, but you're not living in the UK and South Africa. But April 6 next year, he would have been resident overseas for 10 or more of the last 20 years. But
Yeah.
Roger has, getting a little confused, continues to pay a little bit of tax on UK property income, which anybody and everyone must, regardless of residence and origins. Am I still considered UK tax resident? Well, no, you're resident for tax purposes in South Africa, and I think under the statute residence test, you are conforming to non-UK residents. You'd still have to pay UK tax on your UK sourced income, but in UK property income, no one can technically escape that. Bit of capital gains tax planning for your QNUPs, I suppose, if you own property. I'm married to a South African, well done, with children, and I pay local income tax in South Africa. Well, great. Seems like you're compliant in both countries.
Yeah, so agree. But having property income doesn't mean that you're UK resident, and you're still taxed on it as a non-resident.
Then we got a Michael, is an individual, is UK resident, but has been, is an individual, not sure if he means non-UK resident, but has been resident in Spain for part of the last, so individuals UK resident, been resident in Spain for part of the last 15 years. Dual resident maybe. Is there merit in keeping a QROPS based in Malta? The individual has a house in Italy and wishes to consider Italian residency. If he's 55, I'd go for that, Michael, because 55-year-olds with a bit of a pension are taxed at 7% if you reside in a qualifying part of Italy. That's a town of less than 20,000. Not sure the person, though. Looks like you're an advisor. Should he keep his QROPS? Or if it's Michael's client's QROPS?
The principle is for QROPS, if you're planning on becoming long-term non-resident, they're still very useful because they will note that once you're outside of the member payment charges, so after 5 or 10 tax years, depending on whether the transfer was made before the 8th of March 2017. So depending on whether you're in the 5 or 10 year rule, once you've been non-resident and you're no longer within those charges, you can then, there's some scope for planning.
Yeah.
And then if you just wanted to leave it in place, after 10 tax years, it's no longer within, it can't be within this new charge that they're proposing to introduce on the 6th of April 2027. So you can see if you fall within that category where you're going to be a long-term non-resident and you compare having a QROPS with a SIP, then you definitely want to have a QROPS because that's going to be outside of inheritance tax come post 10 years, whereas your UK one, well, there's nothing you can do about it. And as Simon mentioned earlier, it's going to be really hard now to move UK pensions to a QROPS very difficult. So if you haven't
Yes.
done it now, you're going to be locked into inheritance tax, it seems, unless you can become non-UK resident and withdraw your UK pension relying on flexi access and looking at a tax treaty. That would probably be the only way of doing it.
Okay. We'll go on to 10:30 because still got a wonderful amount of people. Then we'll respond to each question thoughtfully, less quickly, and those that we're not answering, will get a response. Steve, someone has been outside the UK for 20 years. Let's say that will be the case in the 6th of April next year, which not many months left, Steve, is there? And recently retired. Good. But returned to the UK, or maybe have returned to the UK. If they left to live abroad again, has this person now lost their 20 years in the abroad bank, being overseas resident for 20 of the last 20 years, but you come back for a year? That's
okay. Yeah.
Is it?
Yeah, no, that's all right.
It
looks back at the previous 20 tax years in the tax year
the
in
previous
question.
20, isn't it?
So if you're UK resident in the 25-26 and you've done 20 consecutive tax years of non-residence, you're absolutely fine for that tax year. And then if you become non-resident in the next tax year, well, you look back and you've done 19 out of the previous 20 as a non-resident, so you're still absolutely fine.
You can do a couple of years. You could almost take him into. He could always go up to 4 years, Lawrence, couldn't he?
Yeah, exactly. That's what I was about to say. If you really wanted to maximise the planning, you'd stay for the 4 years where you're a QNR. You'd benefit from tax-free existence on worldwide income and gains that could be bought into the UK, and then you'd leave. Then you'd have no problem. You'd still retain your status as a long-term resident. You could then hop off and do 10 years away and then come back and benefit from your QNR again for 4 years if you really wanted to maximise the efficiency of the new tax system.
All right. Daniel, a couple of last questions. I repatriated to the UK after 12 years during the 22-23 tax year. Okay, so you've been 12 years away.
So,
hang on, I was assuming I could personally benefit from the FIG regime from year 25-26.
Yeah.
But this would be my 4th year back.
Yeah. So that you'll get it for 1 year. But did he say he started residence in 22-23?
Lawrence. However, this gentleman's been listening to somebody else, rightly or wrongly. Sorry, Daniel. However, someone mentioned if you are UK domiciled, the FIG won't apply. We're talking about 6th of April 25 again. I would likely have reverted UK domicile when I repatriated. Well, under the current regime, yes. In the next regime, we have to look at that. So this has mean I can't benefit from the FIG, or is domicile irrelevant? Well, technically it is. That's on the next year.
Yeah, so domicile is irrelevant. It's quite surprising. We would have thought that a person in the position you've described. So if I'm following it correctly, you became times you were non-UK resident for more than 10 tax years when you became resident again on the 6th of April 2022. So since then you've been resident for 22-23, 23-24, 24-25. So come 6th of April 2025, that's 3 tax years.
3 tax years, Lawrence.
But under the transitional rules, you still qualify for 1 year of QNR status, if we want to call it FIG, for that 25-26 tax year, notwithstanding the fact that for those first 3 tax years of residence, you're quite right, you couldn't benefit from the remittance basis because you were UK domiciled. There's nothing in this draft legislation that takes you out of benefiting from the QNR status. I think possibly the way of looking at it is for persons who were UK domiciled before, it's a complete clean slate for those people from the 6th of April 2025. It just depends on your residency. That's it. You just look at, have you been UK resident in any one of the previous 10 tax years? If you have not been, then you're eligible for QNR status if you become resident again, and also you're not subject to inheritance tax on your worldwide assets. That's how it works. So those people are the real winners from this. new regime. But if you're non-dom, there are still transitional rules in place that you can take advantage of that we've been through today. So perhaps that's the way of looking at it. If you're non-dom at the moment, domicile is still going to be relevant to you from the 6th of April 2025 because of transitional reliefs. But if you're currently UK dom, from the 6th of April 2025, domicile is just out of the window, and it's really just going to be dependent on residence completely.
Okay. A couple more now, quick ones, then we will answer each question that you've posted. There's been 100 questions, ladies and gentlemen, and I don't want to be accused of keeping others on unnecessarily when you've got better things to do in the rest of the day. But thank you for your attention and for staying on for the questions, which are challenging but really quite rewarding for us to receive. Sean, if I returned to the UK in January 23, so the tax year of 22-23, after 11 years, Sean, working in Switzerland, I was there Monday and Tuesday, would I be deemed, carefully I use that, a non-long-term resident, non-dom, as at April 25? Well, yes.
I think it's the same position. So
same position as the previous
forget
gentleman.
About
little
domicile.
Clearer.
You were non-UK resident for 10 or more consecutive tax years when you came back. I think in this case it was the 6th of April 2022. You've used up 3 of your years.
You've used up 3 years.
QNR. You've come 6th of April 2025. You'll have 1 year where where your qualifying worldwide income and qualifying UK gains are exempt from UK tax, even if brought into the UK, provided you make a claim.
Now I know Dr. Anna Per, our Indian specialist tax advisors on this webinar, but it's a husband, but he hasn't said his name. My wife and I are previously Indian citizens. I know about that. Since 1988 became UK non-dom citizen, well, therefore is deemed domicile by this time. In December 2019. Became UK non-resident. In December 2019, despite probably becoming deemed domiciled, before became UK non-resident and works full time in Dubai, and has done for the last 5 years. Well done. Carry on. Where do we fall in the current regime regards tax? I suppose we've got to get to April 2025
well, I think if you look at if you look at the current position, they've been non-UK resident. They were deemed domiciled by the sound of it. They became non-UK resident more than 3 tax years ago.
Yes, they have.
So at the start of the 4th tax year, they lost their deemed domicile for inheritance tax purposes. So their worldwide assets were not within inheritance tax from the start of the 4th tax year. And under the new rule, although under the general rule, they will have been UK resident for 10 or more of the previous 20 tax years come 6th of April 2025. Looking back from 2005 to 2025, they've spent at least 10 of those 20 as a UK resident.
That's right.
They benefit from that transitional rule that we've been going through, or they should do, which should protect them and should ensure that their that their foreign assets remain outside of UK inheritance tax, provided they don't become UK resident again. They need to ensure that they remain non-resident and they do that 10-year, generally speaking, the 10 consecutive tax years to give them the buffer, and then they can go and become resident again, and they won't become a long-term UK resident for 10 until the 10-year mark.
They could be, having lost their deemed domicile, Lawrence, under the current regime, they could be a candidate to set up a trust and have settle or exclusion until they become until they've had to surpass that 10-year term.
Yeah, it's a good point.
Good idea,
so you could, like the Randolph idea, but they're in a better position because they're non-resident, so you won't have the issue of having to exclude them for income and capital gains tax purposes. And I think because of that transitional rule, they won't become a long-term UK resident because of the transitional rule. So I think that if they set up a trust now, that should remain an EPT.
Maybe, yeah. Okay. So a little
Should be,
trust there for the good Indian family. Right. That's 10:30. There's too many more questions. We've just dropped down to 200 people in the room. Thank you everyone for staying on. Thank you, Ravi, for your colleagues saying it was great. I'll take a compliment from you anytime. And Lawrence and I enjoyed. We've had half an hour of questions and more. We'll answer all your questions on email. Thank you, Jess. We've archived the questions and saved so we can respond to them in a timely manner. You'll get a recording. You'll get the presentation. Again, thank you for your undivided attention. We've enjoyed your company, and watch this news. There'll be additional webinars and live conferences in due course, perhaps in the new year. Thank you again, and see you all very, very soon. Lawrence?
Yep. Thanks, everyone. Bye for now.
Thank you. Thanks, Jess and Miguel, as well.